Let's begin with understanding mergers and acquisitions, M&A. Mergers and acquisitions. This happens when two or more organizations merge their operations either partially or completely together. Acquisition in a broad sense means the takeover of one company by another when the businesses of both the companies are brought together as one. In a narrow sense, it is the coming together of two companies which are equal in size. Let's take a look at an example of a merger. The two largest UK pharmaceutical companies, GlaxoSmithKline and SmithKline Beecham, planned to merge their business operations in January 1998. This deal was worth more than £100 billion, but was abandoned at a later stage. If it had succeeded, it would have created the biggest drug manufacturing company in UK, as well as the third biggest organization in the world. The move followed a number of mergers in the industry over a period of 5 years before this happened, which were largely driven by opportunities for cutting costs by way of merging their individual research and development facilities. Acquisition. An acquisition happens when one company acquires from another company either a part of company's stocks, a business operation, and its assets. Let us see a small example on acquisition. Click here. Here is an example of acquisition. Alpha Inc. has assets of $25 million and liabilities of $10 million. Sigma plc wishes to acquire Alpha's business. Sigma can take over Alpha by buying its share capital and also its assets, asking the management to settle the liabilities from the purchase consideration. After purchasing it, Sigma acquires both the assets and liabilities of Alpha Inc. Sigma also acquires any capital losses that Alpha might have accumulated to set off against future profits. Full and partial acquisition. Now, acquisition can be of two types, full or partial acquisition. Full acquisition. Now here, the entire share capital is purchased by the acquirer. While in partial acquisition, only a part of the share capital, that is more than 10%, but less than 50% is obtained by the acquirer. Why do partial acquisitions occur? Partial acquisitions happen because if the target company stakeholders want to retain stakes even after acquisitions, if a few stockholders in the target company refuse to sell stocks. Let us understand this with an example. Click here. The UK pub, betting and prosperity group Brent Walker had set to seek refinancing from its lending banks when it ran into financial troubles. Its subsidiary and a part of the group, the William Hill Betting Shops, was ring-fenced from the rest of the group and had its own syndicate of banks that lent about £350 million. This loan was due for maturity in March 1994. William Hill went up for sale. A consortium of bidders introduced by a merchant bank made a bid for the company for £360 million, subject to the condition that the bid would not be regarded hostile by the board of directors of Brent Walker. At least one more bid was reportedly received, which was an offer to acquire a majority stake in William Hill, leaving Brent Walker with just a minority stake. It was opined that Brent Walker's management would wish to retain its stake in William Hill so that a rise in the subsidiary's value would benefit its own creditors. Mergers and acquisitions versus joint ventures. A joint venture is a type of a partnership business where two or more organizations invest cash or assets in a particular project or a business. The partners or the people who invest can form a separate company for this purpose according to their investment ratio. Here, the organizations involved do not buy each other's stock. The organizations had similar interests and the main purpose is to create a strategic alliance between them. Reasons for buying. The main reasons for acquiring other companies are: Number 1, pursuing a growth strategy. Number 2, defensive reasons. Number 3. Financial opportunities. Reasons for selling. A company might sell its business due to the following reasons: to raise money to pay off its debts, an attractive offer price, selling unprofitable part of the business, lack of funds to invest in developing the business. Here is an example. Oil companies were privatized by the Russian government between 1992 and 1996. They were split into 16 entities and sold out to the institutional and financial investors. A few investors obtained shares of the companies, thus privatized, and in exchange gave loans to the government. More recently, the sector has moved towards reconsolidation by way of mergers of the privatized entities.